Everyone tells you a low PE means cheap. So why did some of the smartest investors lose billions buying cheap stocks? What if the PE ratio isn't lying, but you are misunderstanding what it's actually showing you? The P/E ratio is probably the first number you ever learned in investing. Price divided by earnings. Simple, clean, comforting. And that's exactly why it's dangerous. Because when something feels too simple, your brain stops questioning it. Let me ask you something uncomfortable. If P/E really worked the way people think it does, why do most low P/E stocks underperform the market long term? Why do value traps exist at all? Think about that. If low PE truly meant undervalued, markets would be full of easy money. But they're not. So what's actually going on? Here's the part nobody explains clearly. The P/E ratio does not tell you value. It tells you a story about the past. And markets don't price the past, they price expectations. A company with a PE of 8 is not cheap by default. It may be dying slowly. A company with a PE of 80 is not expensive by default. It may be buying the future early. Let me ask you this. Would you rather own a business whose earnings are shrinking, or one whose earnings barely exist today but could explode tomorrow? The P/E ratio doesn't answer that. It hides it. Let's go back to 2022. Meta's P/E collapsed. At one point, it fell below 10. Everyone called it cheap. Everyone said, this is a no-brainer. But stop for a moment. Cheap compared to what? At that time, ad growth was slowing. Apple had crushed tracking. The metaverse was burning cash. Regulators were circling. That low PE wasn't an opportunity. It was a warning. Now here's the twist. In 2023 and 2024, Meta exploded upward. The PE expanded again. Earnings recovered. Costs were cut. AI became the new story. So what actually changed? Not the PE, the story. Ask yourself, did the PE guide investors correctly, or did investors interpret it emotionally? Banks often trade at low PE ratios. 6, 5, sometimes even lower. People say banks are always cheap. But are they? In 2007, banks had low PEs. In 2008, they almost collapsed the global system. In 2023, Silicon Valley Bank looked reasonably valued. One interest rate shock later, it was gone. Here's the hidden lesson. Low PE often means the market sees risk, you don't. Interest rate exposure, balance sheet fragility, liquidity mismatches. The P/E ignores all of that. Let me ask you this. Would you buy a house just because the price is low without checking the foundation? That's what blind P/E investing looks like. This part will make people uncomfortable. Most investors don't use P/E to make money. They use it to feel smart. It gives certainty, numbers, control. But markets don't reward comfort. They reward understanding. Here's another uncomfortable truth. Professional investors don't use P/E the way retail investors do. They use it with context, or they ignore it completely. So when someone says this stock is cheap because the PE is low, ask them one thing. Cheap for how long? Amazon looked expensive for years. No profits, meaningless P/E. People avoided it. But Amazon wasn't optimizing for earnings. It was optimizing for dominance. Same with Tesla. At its peak, Tesla's PE looked insane. But the market wasn't valuing today's profits. It was valuing scale, software, energy, and optionality. Now ask yourself, if you waited for Amazon to look cheap on a PE basis, would you ever have bought it? Here's the correct way to use PE. Not as an answer, as a question. A high P/E asks, what growth is being priced in? A low P/E asks, what fear is already priced in? If you don't answer those questions, the ratio is useless. If the P/E ratio is so well known, so easy to access, and used by everyone, do you really believe it's still giving you an edge? Or is it quietly pushing you into the same traps as everyone else? Think carefully.